Hey, it's Andrew here with Tried and True Home Loans, and today I wanted to share with you some information about using rental income from a current property you own that you're departing to buy a new primary residence. It's very specific to a homeowner that owns a property, wants to buy a new property and move into that as a new primary residence, but they're going to keep their current house as a rental. So VA, FHA, Fannie and Freddie all have slightly different requirements of how they will use rental income and how you can use this to qualify. The main things that go across the board for all loans is you have to have first month's rent, a deposit check, and a 12-month lease. Those are going to be the basis of being able to prove to the underwriter that someone is going to rent your property and allowing them to exclude that amount of money from your outgoing debt to help your DTI for the new loan purchase. Now, all four programs, there are slightly different things that happen with each one. VA will allow you to use 100% of the rental income you receive to go towards your DTI and your mortgage to cover your mortgage for the house that you're departing from. The other three, FHA, Fannie, Freddie, they only allow 75% from the departing property. So this is kind of how it would work. Let's say the departing property has a $1,200 mortgage and the borrower wants to rent it for $1,500. So they get a signed lease for $1,500 a month, they get a deposit check, and they get first month's rent. They got all three of those things. They have $1,500 coming in basically, but your client is using an FHA loan. So they can only use 75% of the $1,500, which is $1,125. So in that scenario, you're short to cover the mortgage payment of $1,200 by $75. That $75 becomes a debt on your income sheet when you're calculating your new DTI to qualify for the new mortgage. Instead of being hit for the whole $1,200, you're only being hit for $75. Makes it much easier to qualify. This works the same with Fannie and Freddie, but as I said, if you collected the $1,500 and you were buying with a VA loan, they would let you use the whole $1,500 to cover the mortgage payment. So what's interesting about that is FHA and VA will only cover the mortgage payment of the departing home. So even though VA is allowing you to use 100%, which is $1,500 in this scenario, you only need to cover $1,200 for the departing property's mortgage payment. Even though you have this surplus money, you end up as a net zero on the balance sheet towards the DTI. Still a great scenario, and that works the same with FHA and as well as Fannie Mae. Freddie Mac has a requirement that you have to be a landlord for at least 12 months to use income to qualify for a new purchase. One other interesting thing for FHA, if you currently have an FHA loan on your property and you're going to use an FHA loan again, the two properties need to be at least 100 miles apart. So a couple of scenarios that change things around. You've got two different percentages of how much money can be used. You've got a requirement of time as a landlord, you've got a distance of the two properties, and then on top of that, there could be other overlays that each different lender that's potentially going to let you borrow money could require for this purpose. So what you want to do is basically, when you start working with your lender and you start working on this, figure out what loan program you're going to do, and then figure out the details of how your rental income from the departing property can be used to help you qualify for the new home. If you have questions on this topic or other topics, please reach out. Happy to help you. Look forward to talking to you guys in the future. Bye.